Good afternoon. My name is Alison Dunleavy. We'll be getting started here in a few minutes, hopefully just a minute or two. Actually, welcome to the What to Expect from the Biden Administration Tax Law Changes. Very exciting topic for you this Wednesday afternoon. Everyone, if you see your go-to webinar, those of you that have not used this platform before, there is a questions tab down towards the bottom. Please feel free to use that for any questions you may have while we are presenting. We will answer all questions probably towards the end, as we're both monitoring this as we kind of go along. We'll get started here in another minute, but I would like to give a shout out to this slide deck. We had 3 gentlemen from our UHY, our New York office, and I believe St. Louis, that put together this slide deck we're using, the base of it. Paul Truber, Pat Stark, and Mehmet Uger, thank you very much for doing a lot of the heavy lifting as this slide deck was, or a version of it was shared with our executive committee here at UHY. All right, well, so let's get started. My name is Alison Dunleavy. I am a senior tax manager in the tax department in Farmington Hills, Michigan. Again, thank you all for joining. Thomas Sena is going to be giving us a rundown of a few of the slides as we get into the meat of this presentation. A reminder, please, that the VBBA Act is not final. It is still in the Senate. So a lot of these items, if not all of these items, could be changed. Everything could be theoretically scrapped and start again. So this is what we know as of now that we are sharing with you today. So many of you, as you know, change is coming. This is going to be inevitable. There is currently a deal in Congress that's being reviewed. So as this started earlier this year, the bipartisan infrastructure deal was signed into law by President Biden on November 15th. This Build Back Better Act, like I said, passed by the House November 19th, and now, like I said, it's still sitting in the Senate. So theoretically, everything that we are talking about could change again. Just a little emphasis on that. Not a bunch of big heavy hitter tax items in this bipartisan infrastructure deal, but there are a couple things to highlight. The employee retention credit, which I'm sure a lot of you in the staffing industry have heard of, and some of you probably were able to benefit from. The not the CARES Act, but the act that put the employee retention credit into law expanded it to December 31st. It was originally going to December 31st. This bipartisan infrastructure deal pulled that back, and that credit is now no longer available. Any wages paid after 9/30/2021 are no longer eligible for this credit. There has been some guidance very, very recently, like this week, issued by the IRS that tells you that if you were to have already been taking the employee retention credit for Q4 and benefiting from that reduction in wages from your 941, holding back those payments, there is a way to repay those. The credit can still be claimed for 2020, January through September of 2021, and recovery startup businesses can still claim this credit through that originally extended December 31st deadline. Now, reporting of digital assets. this is cryptocurrency. Beginning with the 2023 calendar year, the sale of cryptocurrency would be subject to 1099-B reporting by any broker-dealer. Digital assets would also be considered cash for purposes of that $10,000 banking disclosure rule. And you would have to file that Form 8300 for any cash payments over $10,000 received in a trade or business. This isn't necessarily, this crypto piece of it isn't necessarily a revenue raiser. The IRS is essentially putting this into place is to be a they're getting everybody compliance. So they're trying to sidestep people that wouldn't necessarily be reporting sales of cryptocurrency. It's kind of set in place so that revenue isn't lost on the taxable. And finally, not super relevant to the staffing industry, but it is worth mentioning, the reinstatement of Superfund excise taxes. The potential revenue generation of this is almost $14.5 million over 10 years. So, ideas for the bipartisan infrastructure deal. Please review your eligibility to take the employee retention credit for 2020 and 2021. If you accept digital currency, you're going to have to think going forward reporting. There's going to be reporting pieces that you're going to be responsible for as the recipient. So now I'm going to pass the presentation to my colleague, Tom, who is going to discuss the VBBA as it sits now.
Thanks, Alison, and hi, everybody. I'm Tom Sena. I'm a tax manager in our New York City office. Today, we're going to dive into a little bit deeper into the Act, the Build Back Better Act as contemplated by the Senate right now. So why are we here, right? We've been monitoring, the proposals that Biden and his team have been, talking about for the last, year or so. We got a little bit of clarity in April on a proposed infrastructure bill and a proposed social spending bill. And we really want to know what does that all mean for us as business owners, as taxpayers. And as Alison noted, we got a little bit of clarity just in November on the infrastructure deal, right? There wasn't a whole lot of tax provisions that were noted as pay-fors, right? You have the retroactive change of the ERC and some crypto reporting. But the social spending bill, this is where a lot of those tax pay-fors are going to show up. The Act is focused on expanding childcare programs, reducing healthcare costs, combating climate change, so on and so forth. And in general, this is the framework is focused on increasing taxes for the wealthiest Americans and businesses. So we're going to focus on the current proposal as passed by the House on November 19th. The CBO, the Congressional Budget Office, estimates it's going to cost about $1.7 trillion, and it'll add about $160 billion on a net basis to the deficit over the next 10 years. Again, as the measure, it's in the Senate now. It's expected to be altered. We're hearing, in the news every day, proposed changes to some of the SALT, cap changes and threshold limits and the like. So we'll outline, what we know currently, and it's kind of what we have to go off of, and we'll plan for that and as we move forward. Next slide, please. So first up, what we want to talk about in the first part here is corporate and international tax reforms. What's notable here is the omission of one of the main points that's been a topic since last year, and that's the C corporation tax rate. Initially, there was talk of a 35% rate. Then there was talk of splitting the difference between the current rate of 21% and meeting in the middle at 28%. In September, the Ways and Means Committee noted a graduated structure of 26.5% over income of $5 million. The point of it is it's not currently the tax rate, the domestic tax rate isn't currently included in the Build Back Better Act. So what is included? Next slide. There is a corporate alternative minimum tax. And I don't know how many on the call that this is going to apply to, but the bill as contemplated is set to impose a 15% minimum tax on the profits of corporations that are reporting over $1 billion to their shareholders. So any corporation other than an S, a regulated investment company, or a real estate investment trust that for any 3-year period has average annual adjusted financial statement income, and that's defined in a new code section, of over $1 billion. And in the case of companies that have foreign parents, adjusted financial statement income in excess of 100 million would pay a tax of 15% on its adjusted financial statement income for the year. It's estimated this is only going to apply to about 200 American companies. So again, the biggest companies, there's been talk of, the Amazons of the world paying 0 federal tax. This is set to hit, some companies like that. The legislation does note that the AFSI, the adjusted financial statement income, could be reduced by NOLs for years created after 12/31/2019. So subject to that 80% limit, and it's set to go into effect starting in 2023. Next slide, please. So the next item that's in there as it relates to corporations, back one, is the repurchase of corporate stock. Again, this is mainly targeted at publicly traded companies. So imposing a tax of equal to 1% of the fair market value of any stock of a corporation that repurchases its own stock during the year, effective starting in 2022. So again, this is going to apply to domestic companies that are on established securities markets, publicly traded companies, and it's intended to prevent corporate executives from executing buybacks for their own benefit. Again, it's been a hot topic. So this is currently in the bill. Next slide. An item that may, be more relevant for many of you on the call is the limitation on interest expense deduction. So this part is two-pronged. The first is there's going to be a new section 163N that would limit the net interest expense of domestic corps that are members of an international financial reporting group. So if that's the case and internationally you're reporting, it's going to limit the interest expense deduction to an allowable percentage of, they're defining it as 110% of the domestic company's net interest expense. So that's one prong. The second prong is the business expense deduction limitation. So for those of you that have debt, significant interest expense, and you have significant gross receipts, I'm sure you've known over the last couple of years that you may have a limitation on your interest expense deduction. Currently, that limitation exists at the entity level for flow-through companies. So for partnerships and for S corporations, that limitation exists at the entity level. Now for partnerships, that does pass through to its partners as excess business interest expense, and it's deductible in subsequent years once the taxable income is able to offset and utilize some of that. Currently, at the now as it exists for S corporations, that limitation, if you have a limitation, it's carried over and tracked at the corporation level, at the S corporation level. As it's proposed right now, starting in 2023, this is going to be applied at the partner and shareholder levels. So for partners, any excess business interest expense that would be carried forward is going to be treated as paid or accrued in the first year beginning after 12/31/22, and there would be a similar transition for S corporation and their shareholders. What's noteworthy here, so this is again going to be tracked potentially at the partner and shareholder level. The applicable threshold, the gross receipts test, the 25 million in revenue, the small business exemption, that still applies at the entity level. But when taking into the limitation at the partner level, you're going to take into account the distributive share of all companies that you're involved in for purposes of the gross receipts test. And similar rules would apply to S corporations and their shareholders. Next slide, please. Next, for those of you that have subsidiaries overseas, controlled companies that you're involved with, again, I'm sure you've grown a little bit accustomed to GILTI and the repatriation of income over the last couple of years, and foreign derived intangible income as well. The bill is set to reduce the applicable offset. So the Section 250 deduction, the benefit that you would get to offset some of that inclusion, they're setting to reduce that deduction. So for FDII, the deduction of 37.5% that companies are otherwise entitled to would reduce to 24.8%. And for GILTI, they're set to reduce the GILTI deduction of 50% down to 28.5%. And what that does, reducing the deductions, effectively bumps up the GILTI rate. So that's what you see on the slide there, bumping it up from an effective rate of 10.5 to 15. And the other item here that's interesting is if you have multiple companies overseas, what you've been able to do over the last couple of years is effectively offset on a net basis the income and losses from different jurisdictions. The bill would set to have the GILTI provisions apply on a country by country basis. So if you have income in one jurisdiction and losses in another, you can no longer offset. You'd have to repatriate the income, and the losses from the other would carry forward. So that's a big item if you're operating in multi-jurisdictions there. Next slide, please. Same thing with the foreign tax credits. So those are going to apply on a country by country basis as well. And this would be effective starting in 2023. So something to note there, again, if you have subsidiaries overseas and you've been subject to the repatriation of income, there could be, a larger tax impact. So again, not touching the corporate tax rate as it stands right now, but some of those international provisions and doing business overseas, the repatriation of that, they're looking to hit that, effectively bumping up the rate in that way. Next slide. Next is R&D expenses. So, talking about something, we've been talking about kind of negatives, revenue raisers. An item that's in the Act, particularly relevant, for anybody that has research and development expenses. The Build Back Better Act does favorably extend the expensing treatment for 4 years. So this provision was set to expire starting in 2022 under the TCJA. And what would have to happen is that you'd have to capitalize and amortize the research and experimental expenditures and amortize that over a number of years. What the Act would do is it would allow expensing over the next 4 years until 2026. And this is, again, to try to be a little bit more competitive worldwide, spur economic growth, encourage R&D investment in the U.S. So this one has bipartisan support. So, whatever changes do exist or whether the Act does pass or not, I would expect this to be an item that probably stays. The next one is the payroll tax credits as well. So, for small businesses, if you've just been starting, over the last 5 years and you meet certain gross receipts criteria, you have the ability currently to claim up to $250,000 of research credits to offset your FICA payroll tax. The VBBA favorably increases this threshold to $500,000. This would be effective starting in 2022. So anything in excess of that amount is generally carried forward as a general business credit, but this provides immediate relief in cash flow relief in a offset to the payroll taxes that would otherwise be due. Next slide. So this provision is a pretty big one. For those of you that operate in a C corporate structure, or you have other investments in private companies, private corporations, Section 1202 of the code is better known as Qualified Small Business Stock, QSBS. Currently, there's allowed either 50%, 75%, or 100% exclusion of the gain on the sale of that corporate stock, depending on when you bought it and depending on a number of threshold criteria that the company would need to meet, being a small business during the time that you held the stock. So I think it's years after 2011, if you have a qualified business, you can effectively exclude up to 100% of the gain on the sale of that stock, up to, I think it's $10 million or 10 times the adjusted basis. So a huge provision, a huge benefit that's been out there. The BBBA would set to eliminate the 75% and the 100% exclusions if you have adjusted gross income over $400,000. So that's been a talking point, as high income is that $400,000 threshold. Over the last years we've been hearing about it. So this would set to reduce or eliminate a few of those gain exclusion items for high income taxpayers. For all trusts and estates, it's going to be capped at the 50%. And this is going to take place. So what we're talking about in a lot of these provisions are proactive changes in years in the future. This one is retroactive. So if you have any transactions that occurred effectively in the last quarter of this year, and this bill passes, and you were otherwise entitled to the 75 or 100% exclusion, it's not going to be allowed. So any sales that occur after September 13th, this is when that provision is going to take effect. So take a look at if there were certain written binding contracts in effect as of that point in time. But yes, a huge benefit that had been available to investors and small companies, founders, that is set to eliminate some of the exclusion there. Next slide. So those are some of the corporate tax reforms. What does it mean for individuals? What's in the act right now, or what's not in the act right now for high income individuals? So again, what's notable here is there was talk of increasing the top federal tax rate from the current 37% to 39.6%, going back to the old rate. That's not in the bill currently. There was talk of taxing capital gains at ordinary income rates if your income's over $1 million. That's not currently in the bill. QBI, a huge benefit for staffing industry owners. There was talk of phasing out that benefit of income over $400,000. That's not currently in the bill. So some good news. What is now in the bill? So for those of you that are active in your trade or business, there's something called net investment income tax for passive owners, right? Typically, there's a 3.8% net investment income tax if you're just a pure investor, you're passive in the business. What the bill is set to do is it would amend Section 1411 to have this take effect, this 3.8% to take effect for those with income over 400,000 and those that are active in your business. So this is another huge provision. Even though the top ordinary rate isn't currently in the bill, this is something that could apply to a lot of business owners that are out there. So you see the different thresholds there, based on your filing status. If married, filing joint, 500,000. If you're single, 400,000. This would eliminate some of the benefits. So for those of you that are operating in an S corporate structure, this would eliminate some of the benefits there that you're otherwise receiving right now. Based on that, what is reasonable comp, that whole conversation, and what can you take in distributions. This would eliminate some of that benefit there. Having a 3.8% tax on your income. It would be effective for years starting next year in 2022. Next slide. So for those of you that have had losses from your business, the bill would set to make permanent Section 461 to limit excess losses of non-corporate taxpayers. So what the TCJA did was it limited the use of excess business losses for individuals, and that was suspended the last couple of years under the CARES Act. So for 2018, 2019, 2020, that was limited, that provision, and the limitation was set to expire after 2025. What the provision would do now is it would, now it was set to currently take effect in 2021 anyway, but it's going to limit the current use of losses that now exceed 524,000 for those that are filing joint and 262 for those that are single in 2021. That's inflation adjusted for the 250 and the 500 on the slide. And currently, the unused losses become some part of the net operating loss carryover to the following year. What the VBBA does is, there's two changes. It would make the limitation permanent. So it was originally set to expire, it would make the limitation permanent. And additionally, the unused portion of the losses to effectively offset some other non-active income, it wouldn't become part of an NOL carryover. It would retain its character as a business loss, and it would be carried over and subject to the limitation next year. So a little bit of a technical item there, but two proposed changes. And if you haven't, been talking with your tax advisors, as part of year-end planning, and you have some losses this year, and they haven't raised up that particular issue yet, you could have some limitation on the ability to utilize losses. Next slide, please. The next item is another really big one, especially for those, we've seen, a lot of contemplated transactions for our clients, this year, trying to get it in before the end of the year, because of a lot of the uncertainty that's been out there on some of these proposals. One of the items that's in here is a surcharge on high-income individuals, estates, and trusts. So this would create a new section imposing a surcharge effectively equal to 5% of the taxpayer's AGI that exceeds 10 million, and plus 3% of the taxpayer's AGI that exceeds 25 million. The modified adjusted gross income that they note in the proposal is gross income less investment interest expense. But just note, these are surge taxes in addition to the highest rate of tax, so currently at 37%. So for anybody that was contemplating an exit transaction, getting it in before the end of the year becomes, incredibly important should this provision pass, because you're looking at, potentially up to another 8% in federal taxes there, if you have a significant exit event. And this is, for beginning taxable years starting next year. So again, the planning that's required, again, if you're engaging in those talks, we have a few clients that are talking about, eliminating aspects of escrow or putting clauses in place to, try to close before year end. Next slide. So big talking point in the news, the current SALT cap. So for those of you that are in, high tax states, New York, California, New Jersey, so on and so forth, you've known the impact of, the limitation on itemizing deductions for state and local taxes. So state and local taxes paid, real estate taxes, that's been capped at $10,000. That was set to expire starting in 2026. What the VBBA would do is it would bump up that cap to $80,000. So favorable item in here. There's been a lot of talk here and potentially setting an income cap for the ability to utilize, some of the higher thresholds here. So we'll see. But what this would do is it would keep that cap in place for 10 years, and then it would revert back to the $10,000 cap in 2031. Next slide. So corporate and international tax changes, high net worth individual estate trust tax changes. Another big one, another big item is modifying some of the rules relating to retirement plans. So one of the items that is currently contemplated in the bill is prohibiting further contributions to a Roth or traditional IRA if the total value of the IRA or defined contribution retirement account would exceed $10 million. So there's two items here. If your income is over those thresholds, $450,000 if you're married filing joint, $400,000 if single, and the aggregate amount of the retirement account balances exceeds $10 million, it would prohibit making further contributions. The talking point here is if that's relevant to you, there's a significant minimum distribution that is going to have to take place. They're defining balances that exceed $10 million at the end of the year. Effectively, the amount over that $10 million for those high earners would have to take 50% of the amount out as a minimum distribution for the amount that exceeds the $50 million. So if you have 11 million, that your balance exceeds the 10 million limit by 1 million, you'd have to effectively pull 500,000 out, which could cause a significant tax event. But this is generally effective for years starting in 2029. So just be mindful of that. If you have accounts that may, be reaching that limit, we're planning to reach that limit over the next number of years. This is a provision that could potentially impact you. Next slide. The backdoor Roth conversion. So, there's been a lot, in the news with, I think, Peter Thiel and his investment with, self-directed Roth IRAs and being able to take, the $6,000 limit and grow it to, a couple $1 billion. They're trying to, kind of limit that. So for higher income taxpayers, what you could currently do is they made this, something into law. They're effectively allowing this through some of the regs. And if you are not allowed to contribute to a Roth IRA directly, if your income is over, I think it's some $200,000 number that's indexed for inflation, you could effectively make that contribution to a traditional IRA and then convert that to a Roth. This would effectively limit that or eliminate that starting next year. So a good planning tool that is utilized and fairly common that could potentially be eliminated there. And then Roth conversion limitations. So if you have a Roth 401k account, it would limit the ability to convert that if your taxable income exceeds certain thresholds. And this would take place starting in 2032. So again, a little bit longer time horizon in, thinking about some of these provisions, but, things that could definitely impact, a lot of us that, are in business, right? Next slide, please. So a couple tax planning ideas. Non-corporate taxpayers, individuals with losses, determine the potential impact of not being able to utilize those losses to offset other items of income, and whether that excess business loss limitation applies to you. Another planning idea, and Alison's going to talk a little bit more about this on a lot of different strategies that are available. Depreciation planning, manage your income and losses. You may want to potentially opt out of bonus this year to play that tax rate arbitrage game, and carry forward the losses to higher tax bracket years. So things that you can do there, or more currently, consider an R&D study if you want to maximize some of your expenses. If you have if you own a building or a leasehold, you're doing a lot of leasehold improvements, they could effectively bifurcate that and give you an immediate benefit there. But again, what has been on the table as far as proposals, but are not currently in here. Again, that flat corporate tax rate, it's not in here. 28%, it was contemplated. Bumping up the top individual rate, not currently in there. Increasing long-term capital gains rate, income over $1 million. I think they were talking about taxing it at ordinary income rates, not currently in there. Qualified business income exclusion, so that 20% haircut on your net income. They were talking about phasing that out. It's not currently in the bill. There was also a lot of planning around succession and whether there was going to be a reduction to gift and estate tax exemptions. Haven't talked about sunsetting that or eliminating certain valuation discounts. Alison's going to talk about this a little bit more in detail. But again, some of these items that were kind of, I'm not going to say locks, but contemplated over the last year are notably not in the bill currently. So we'll be on the lookout. For potential changes as this moves its way through the Senate. But this is what we have to work off of currently. So next, I'm going to hand this over to Alison to talk about some other planning ideas on what you can do between now and year end.
Awesome. Thanks, Tom. All right. Well, I'm going to start talking about planning. Again, what we think should be done between the current proposed law and what is in, currently in place as law. Again, all of this stuff could change. The whole entire bill could get shredded and re-put together, and everything on that last slide that theoretically is currently out of the bill could get put right back in. So, just a little caveat. All right, one of the hot topic items, especially for staffing companies over the past 2 years, has been state and local tax planning. We call it SALT in our arena, and as you can imagine, and going through COVID, many of the states, cities are short on cash. Up here in Michigan, we're even bankrupt. So a lot of these localities and states are looking for additional money. And essentially through COVID, many employees had to start working from home. So for example, if you have an employee that lives in New Jersey, works in New York, or lives in Virginia, works in DC, you get where I'm going, where are they physically located? Where are they physically working? Should their wages be taxable to the state they're living in or the state they're working in? Going a little bit even further, many of the states for services like staffing, they source income as a way to allocate your income across states. So if you have $10 million of gross receipts, but you have employees placed in several different states, you have to come up with a way, well, the state tells you to come up with a way that they want you to allocate your income to them. And the term that's used there commonly is economic nexus. And there's 2 ways to determine nexus. And of course, the states all can't get on board with each other. And one of the ways is where the benefit is being received or where the cost of the benefit is being produced. So for example, if I have an employee sitting in Colorado that's doing work for a California company, California says that benefit of that Colorado employee, all that money they're generating for your company needs to be sourced to California. Whereas Colorado or maybe some other states would say, no, that employees sitting in our state, they're generating the revenue in our state, your income should be sourced to us. Again, the states have different rules, and it's only been impacted by the new COVID, the new remote working. There had been a tax on PL 86-272. That is an old law that protected companies going into states and just soliciting orders. Again, not really applicable for service type entities, but it is something to think about as these attacks grow. And recently there were decisions, the Wayfair decision, Amazon, all of these multi-state, multi-country, it's causing these broke states to turn back into themselves and look for new ways to generate revenue. I spoke a little bit about market and cost of performance. That's what I just said. You have an employee maybe sitting in one state, but the work that they're doing is for a customer in a different state. That, those 2 states might both want income allocated to them based on where the employee is sitting and where the benefits being generated. You might essentially have to do an apportionment schedule, which is how you allocate your revenue amongst the states, 2 different ways. There is now with the SALT cap at $10,000, which could be going up to 80, which is great. There is a workaround called a pass-through entity tax. Again, not all states are on board with it. Not all states have passed this pass-through entity tax, but the higher state rate states have passed it. New York passed it, California passed it, I think Wisconsin passed it, and it's essentially the company would be paying tax on behalf of the owner for the state and then deducting it. That would be something to look into if you're in a high tax state, or even if you're not in a high tax state, but have workers in California, New York, some of those higher tax states. Some charitable contribution planning. So for 2021, as a reprieve, much like how meals are 100% deductible for 2021 and 2022, entertainment is still not deductible. But for 2021, you are allowed to deduct charitable contributions up to 100% of your adjusted gross income. The previous rule was 60%. That came in with the TCJA. But with this 100% rule, the caveats are as follows. They must be cash contributions. So any, goodwill type contributions, if you were to donate appreciated stock, that doesn't count. It's just cash. It must be paid directly to a charity. So again, like a private foundation wouldn't be allowed to, wouldn't be an eligible foundation. And you're not allowed to do it to donor advised funds. So donor advised funds are a tactic to, if you have a windfall of income, to set up a fund at like a JP Morgan and put in $1 million, say, of money that you then advise over the next several years where you want that money directed to. So you get the deduction up front. In the first year, you donate all 100 million of that, but that foundation, then you get to hold on to it and then direct where those funds go over the next few years. Those are not allowed either. Now, not to say that, please don't do any of these things. Those items are just limited to that 60% deductibility up to AGI. Now, as Tom said, depreciation planning is going to be very important for 2021. Because these losses, these excess business losses could go back into effect, and these NOL limitations could go back into effect, it's going to be important to manage your loss, I guess. A lot of companies will manage their fixed asset purchases to maybe drive them into a tax loss, but have, be cash flow positive, which is not a big deal. But now that there's this second tier of not being able to deduct all of your losses, it's going to be something that you may not necessarily want to front load, like a bonus depreciation or a Section 179. So for 2021 and 22, it's still at 100% bonus depreciation. And then I believe this came in with the Tax Cuts and Jobs Act. It then goes down year over year, 20%. Section 179, you're maxed out at $1,050,000 for 2021, $1,080,000 for 2022. And then remember, you have that limitation of amount of equipment or fixed assets you place into service. Again, if you're a service-based industry, you're probably not going to hit that 2.6 million, 2.7 million with things that you're putting into service, more of like a manufacturing type thing, but worth noting. So if maybe some of you had PPP funds that you have excess cash, cash flow, and you decided to buy your building that you're in, or we're looking to do something like that, it may behoove you to do a cost segregation study. I have never in my career said, no, that's probably not a good idea to a cost segregation study. Cost segregation studies can cost anywhere from $5,000 to $10,000, but accelerate hundreds of thousands of dollars of depreciation. And how that's done is you may have a building you purchased, which would be typically 39 years. You give the blueprints over to a cost segregation study professional, and they go in and identify, is this a pipe? Is this a leasehold improvement? Is this 5-year, 7-year, 15-year property? And therefore, that depreciation becomes accelerated, sometimes even able to be bonused. But again, you want to be careful that you manage your depreciation, especially with this business loss limitation and NOL limitations that could be coming back into play very soon. So like Tom said, you might want to slow down the depreciation. Manage your tax rate. Maybe you as an individual picking up a partnership interest or an S-corp interest of your business, if you have enough of a loss or, but you've also got wages, you can, now's the time to plan those numbers out and see if you can maybe put yourself in a lower tax bracket by a depreciation deduction, but not get you into that danger zone of losing out on those deductions for the year. Not that you're going to lose the deduction entirely, it's just the benefit of it won't be received as you normally would over years past. Deductible interest expense. Again, many of you may not be in this bucket because the first, there's a couple different ways that you could fall into this 163J trap. One of them is if your gross receipts are up over 25 million. And if the new law comes into effect, you would have to, and you're a person of many investments, you would have to take your percentage of your investments gross receipts. So you very well may be put up into this 25 million, I believe it's 26 or 27 indexed for inflation. But currently, the interest expense could be limited to the amount of interest expense allowed based upon your business income for the year. Essentially, there's a recomputation of your taxable income. It takes your ordinary income, whether it's page 1, it adds back your depreciation expense, amortization expense, essentially non-business expenses to get your adjusted taxable income. If you have a loss there, your interest expense that you paid inside your company is going to be limited. So this is going to be something that if the law changes, I have a feeling a lot of people are going to be scrambling, a lot of people that maybe have many investments coming from different sources to make sure that their interest expense that's flowing through to them is not going to be limited. There are two ways that you can kind of sidestep this 163J issue, because 163J impacts entities such as heavily real estate, because real estate entities essentially pay mortgages, which are interest and principal, and have depreciation. And typically, because of that large depreciation, they run tax losses. So the real estate industry was able to lobby and have kind of this 163J7 election, that if the real estate entity said that we promise we won't take accelerated depreciation, please don't limit us on our interest expense. It's not necessarily pertinent to the service industry, staffing, but many of you are probably involved in real estate entities as well as other investments you may have. Like-kind exchanges are gone for personal property. So it's limited to only real property. So many of you may have cars in your businesses, and it used to just be that you went to the dealership, you turned in your car, they gave you a new one, you handed, the statement to your controller, to your CFO, and they essentially just made the trade in your books. It must be treated as a sale, and sometimes could even throw off taxable income. So if you're tossing around the idea of maybe turning in your car or selling it, especially with the car shortage going on right now, you may want to look into that because it could theoretically throw off a gain that you weren't expecting. Now, this 20% qualified business income deduction, this is the deduction that passed with the Tax Cuts and Jobs Act. And it essentially allows taxpayers, active taxpayers, that 20% business income deduction, which comes out to, it essentially tries to even up the 21% corporate tax rate to the pass-through, flow-through effective tax rate. So You may be eligible to receive a 20% deduction of qualified business income from a domestic business as, a sole proprietorship, LLC, partnership, S corp, trust. It can be taken by individuals, some trusts, some estates. C corps are not eligible to take this deduction, and again, that's because they have that beneficial 21% flat tax rate already in effect. This for a while was thought to be on the chopping block, but it's currently not in the bill. Tax planning ideas around this could be, I know some of you typically maybe put a bonus through to yourself at the end of the year, depending on how your profits shook out, or I've seen clients do it where they pay their federal income tax through their wages. The idea is to keep that money inside the company. Take a distribution, take a non-taxable distribution. The more profit you keep inside the business, you're going to get that 20% deduction for, versus pushing it out onto your W-2 and paying that higher ordinary tax rate that you're at, in addition to the FICA and payroll taxes. Non-operating loss utilization. Again, Tom spoke about this. Various tax law changes. Things have gone all across the board of how you're able to use NOLs. NOLs generated before 12/31/2017, so for tax years 2017 and before, there was a 2-year carryback, a 20-year carry forward, and you were able to offset 100% of that income. This is probably what the most of you remember. These rules changed with the Tax Cuts and Jobs Act, that first act that former President Trump pushed through. He changed the rules to, he wanted to limit the business losses, and he only wanted 80% of the NOLs available to be used. That was what the law was. But now the CARES Act came through because of COVID. Nobody expected that. NOLs beginning after 12/31/17 and before 2021, so tax years 2018, 19, and 20, you have a 5-year carryback, an indefinite carry forward, and you're eligible to offset 100% of income prior to 2021 and 80% after 2020. So a lot of you may have remembered this. I remember this when the market crashed in, 13, I think, 12, 13. There was a 5-year carryback that a lot of people took advantage of. This is kind of the same thing. Now, NOLs beginning after 1/1/2021. No carryback, indefinite carry forward, but we can only offset the 80% of taxable income. So again, this is kind of what I go back to, managing depreciation and managing losses. Estate planning. Again, everybody thought that this was on the chopping block, and everybody started scrambling around. We had lawyers calling us, doing gifts for everybody and their brother. I guess, again, this could change. It is not in the VBBA yet. The lifetime exclusion coming to an end this year, 11,000,007. 2022 is 12,060,000. Again, the amounts will be adjusted for inflation as they have been in the past. If you want to make a couple gifts, you've got some time left for the end of this month. That limit is $15,000, $16,000 next year. So if you and your husband have 2 children, you are each allowed to gift $15,000 to that child, and it will not eat into your lifetime exemption. So again, this is very important as the generations continue to age, people looking to maybe get out, start kind of getting their wealth out of their estate. This is a very huge planning tool that's available. Now, another item that could be pertinent to everybody on this call is, as business owners, is, like I said, getting wealth out of your estate. All of you have worked very hard to grow your business. and you're looking to maybe transfer it to the next generation, transfer a part of it to the next generation, and you could theoretically do so by gifting. In order to gift a piece of your business, a private company, you would have to get what's called a valuation. These are important because it has a third party come in and value your business. And that value that they give your business determines the gift amount that you're giving to your descendants. You obviously want to have for tax purposes, a low gift amount because it doesn't trigger gift taxes. And the more you get out of your estate, the less will be in your estate and theoretically taxable down the road when you pass. Better to do it now. We have no idea what the estate tax limits will be going forward. They are set to revert back to 2017 amounts after December 31st of 2025. So getting a valuation, starting that transfer of, whether it's a part of your business out of your estate, it also allows that, let's say your business grows 25 million right after you were to gift it, and by the time you sell it a decade down the road, that growth would be, tax-free outside of your estate. It also allows you to transfer to the next generation, but you keep that majority control. So it's definitely something for business owners that are looking to, start that transfer to the next generation, or, need to look at their estate as a whole and what items they can move to the next generation, so that the last thing we want is to have you all out there pay, I believe it's 55% the gift tax rate, which is pretty obscene. So these are some really important items. The items that I spoke about, regardless of the VBBA, are important things to think about this year, and pretty much at every year. It's a good thing to get into the yearly habit of especially looking at your estate as you begin to get older, and identify items that you could want to, start the process of moving. So I think we've got 2 minutes left. There is one question. And no, appreciated stock, it's only cash. And you can trust in remaining cash. Yeah, just a moment. Unfortunately, this block is really small and I can't open it up. I wish I could open it up. Can you open it up, Tom?
No, mine's small too, but the question, so I can still contribute appreciated stock at fair market value up to the 60% limit to a donor advised trust to offset 60% of income, and then remaining via cash contribution to a designated charity. So I think that this had to do with the charitable contribution limits. Yeah.
So cash would only so the 60%, yes, you can essentially give appreciated stock, you can give to a donor advised fund at that 60% limit. That 100% kind of freebie that's going on for 2021 and 2022, that's only cash. So you would be able to do whatever you wanted with your other typically contributable items. It would just be at that 60% rate. This is only for cash, only to approved charities, approved 50% public charities. I hope that answers the question.
I think the other one was CPE. I think it's CPE for this.
I don't know.
Yeah, we can certainly find out.
Yeah, we'll definitely find out for you. Well, thank you all very much for joining us. It's 4 p.m. My name is Alison Dunleavy, UHY out of the Farmington Hills office. Tom Sena, my colleague out of New York. Again, we appreciate your time, and thanks for joining us.
If you have any questions, feel free to shoot us an email. I think we have another slide.
Yeah, we've got our slides.
Our emails are on the slide there. If anybody has questions that they didn't get a chance to ask, we're happy to give you the answer or find the answer as best we can. So thank you for again for taking the time, and hope to see you again soon.